Hi, my name is Dave Cheney, Vice President of Investments for Paradigm Wealth Management. Thank you for joining us today for our mid-year update. The first half of 2021 saw encouraging developments, both in terms of public health, the economy, and financial markets. First and foremost, vaccination rates have approached 50% in the US, and COVID hospitalizations fell to the lowest level since the inception of the pandemic. While some work remains to be done globally to promote vaccination and concerns remain around the Delta variant, the global economy has made progress towards normalizing from the pandemic slowdown. The economy likewise continued its recovery with the assistance of supportive monetary policy from the Federal Reserve and continued fiscal spending from Congress. This recovery has led to higher commodity prices, higher inflation, and strong returns in equity markets, offset by modest losses in broad bond indices. As we look to the second half of the year, we focus on the interplay between headwinds on one hand and tailwinds on the other for global markets. On the positive side, 2021 is shaping up to be one of the strongest GDP growth years in decades. Jay Powell and the Federal Reserve have committed to keeping borrowing costs low to support continued growth, employment, and inflation. The U.S. consumer is in strong shape. The stimulus has been partly used to pay down debt and increase savings. The current savings rate in the U.S. is at an abnormally high 14.9%, which supports future consumption as the economy continues to reopen and individuals are more apt to consume. A catch-up in vaccination efforts outside of the U.S. is also supportive of a broad global economic recovery. Some potential tailwinds, however. First, the markets have been fueled by monetary and fiscal policy. Monetary accommodation to support the economy in the crisis was 6 times what we saw during the 2007-08 financial crisis. Combined with increased fiscal spending, the Congressional Budget Office projects a $3 trillion deficit for the year, pushing outstanding debt to $21 trillion, or a near-record 105% of GDP. The bill for debt-fueled growth will eventually come due. Second, extreme valuations. Market valuations have reached extremes not seen since the 1999-2000 tech crisis. High valuations make the market more fragile to any potential disappointment. Third, rising interest rates. Inflation has significantly picked up to levels higher than what the Federal Reserve is comfortable with. To date, the Fed has written these inflationary pressures off as transitory, but signs of wage growth, commodity price increase, and a potential for a falling US dollar all point to the risk of more persistent inflation. A rise in interest rates would likely challenge the extreme valuation of tech stocks, which represent a very high concentration of the US indices. Our themes for the second half of the year are, number 1, go higher in quality across the portfolio. We are increasing the credit quality and decreasing the interest rate risk of our bond positions, and looking to areas of the equity market that, in our view, trade at levels much more justified by their underlying fundamentals. Number 2, diversify. In a persistently higher inflation environment, we see a strong case for industrial commodities and for precious metals to offer some strong returns and to potentially diversify a portfolio of just stocks and bonds. And third, look internationally. Europe has lagged in its vaccination efforts, but data suggests that is making progress. It also trades at significant discounts to the US market and a lower bar for corporate earnings to beat expectations. Emerging markets also offer significant value in a depreciating US dollar environment. Thank you for joining us, and thank you for your business.